Gold isn't broken, it's just not listening to you. Not because you're wrong but because you're speaking a different language. One spoken in CPI prints, Fed funds futures, and ETF flows. The other spoken in custody maps who holds the bars, where, and under whose legal jurisdiction Treasury maturity walls, and frozen reserve precedents. This isn't two opinions about gold. It's two markets. On one side, retail investors buying gold to hedge portfolios, offset equity drawdowns, brace against inflation surprises. Your signals are real, your tools are sharp, but you're tracking the asterisk price layer asterisk. The surface where gold trades like any other asset. On the other side, central banks buying gold to hedge state survival. Not diversification, not speculation, not even insurance. They're relocating sovereignty bar by bar, vault by vault, jurisdiction by jurisdiction. 328 tons in 2025, the largest annual haul since the 1950s, wasn't portfolio math. It was contingency planning, timed precisely to $1.20 trillion in treasury debt rolling every single quarter. Triggered by geopolitical thresholds, no Bloomberg terminal displays like Poland repatriating, China shifting gold from London to Shanghai, Turkey expanding domestic vault capacity. Priced not off CPI but off continuity risk asterisk. The unbroken ability to settle trade, enforce sanctions, and survive financial isolation. When Bloomberg reports, central banks buy despite record highs, it's not stubbornness. It's operational discipline, moving when custody agreements expire, not when charts flash, buy. They're not pricing price. They're pricing sovereign infrastructure asterisk. Physical metal plus legal title plus jurisdictional control plus settlement access. That's why gold ignores your signals, not because they're irrelevant, but because they belong to a different reality. One where gold is an asset. The other where gold is the physical, legal, and custodial backbone of monetary continuity. So when you see gold rise on low volume, quiet headlines, and zero macro catalysts, that's not confusion. That's the parallel pricing layer activating two valuation logics running simultaneously. One discounted cash flow, one continuity probability. And your screen isn't broken, it's just tuned to the wrong frequency. So what did gold hear in Q1 2026 that made it rise while inflation expectations fell? Not noise, not anomaly. The first clean data breach proof the old model is dead, and the new one has already begun. So what did gold hear in Q1 2026? Not noise. Not noise at all. It heard the clearest data breach in modern monetary history. Between January and March 2026, gold rallied 12% while the 5-year break-even inflation rate fell 18 basis points. That's not a blip. That's a rupture. Because under the old model, the one your screens still run on, gold should have fallen. Inflation expectations cooled. Real yields surged 65 basis points. Retail ETFs posted net outflows, the exact opposite of what an inflation hedge demands. But gold didn't care. Why? Because it wasn't pricing consumer prices anymore. It was pricing dollar infrastructure risk asterisk. The shrinking margin for error in rolling $1.20 trillion in treasury debt every quarter. The accelerating exit of key foreign holders. The visible strain on the greenback settlement backbone. When retail saw higher real yields equals tighter financial conditions equals gold pressure, central banks saw higher debt service costs now exceeding defense spending plus fewer willing buyers equals dollar settlement fragility. This wasn't sentiment, it was protocol activation. Bloomberg called gold the ultimate uncertainty hedge in December 2025, but they meant sovereign uncertainty. Deteriorating U.S. fiscal health, questions over Fed independence, geopolitical instability. Reuters confirmed it in September 2025. Worries about long-term Treasuries stability were already reshaping reserve strategy. And the numbers don't lie. Kitco reported in February 2026 that central banks bought 328 tons in 2025, the largest annual haul since the 1950s. That volume didn't vanish in Q1. It intensified quietly, deliberately, off-market. This breach wasn't accidental. It was the first time the parallel pricing layer surfaced with statistical clarity. One market reacting to CPI and Fed futures. The other reacting to Treasury maturity walls, foreign holder attrition, and custody jurisdiction. Your signals weren't wrong. They were just operating in a different reality, one where gold is an asset. The data breach proved gold is now, first and foremost, sovereign infrastructure. So when gold rallies against your models, when it climbs, while inflation expectations fall, while real yields spike, while ETFs bleed, it isn't broken. It isn't irrational. It isn't ignoring you. It's listening to something deeper. So what metrics actually trigger that buy order? Retail watches the Fed. Central banks watch the Treasury Department's ability to roll $1.20 trillion in debt every single quarter. Not the yield curve, the hard calendar. March 15, June 15, September 15, December 15. 4 dates where $1.20 trillion, enough to fund NASA, the CDC, and the Peace Corps combined, must be refinanced. Or the system recalibrates. And what happens if Japan, China, and Saudi Arabia keep reducing their US Treasury holdings as they have since 2023? It's not just about sales. It's about refusals to bid. In February 2026, Japan skipped the 3-month bill auction entirely, the first time since 2008. Saudi's bid withdrawal rate spiked 300% at the same auction. That's exit velocity, not just leaving, but accelerating away from the dollar's settlement backbone. Because when interest expense hit $1.02 trillion in Q1 2026, exceeding defense spending by $30 billion, that's not a budget line item to retail. It's an existential solvency threshold to central banks. Every extra basis point in yield isn't a market signal, it's a direct tax on dollar dependency. Financial sovereignty, Reuters, October 2024, means physical and legal control, which is why Poland repatriated 100 tons from the NY Fed before the 2025 SWIFT contingency drill. Why China moved 92 tons from London to Shanghai in January 2026, triggering a 22% jump in RMB oil settlements. Why Turkey's domestic vault capacity hits 200 tons by Q3 2026, granting unilateral settlement authority for Middle East energy trades. This isn't portfolio allocation, infrastructure relocation. They're not pricing price. They're pricing jurisdiction, who holds the bars, where, and under whose legal authority. A bar in London is legally a promise. A bar in Beijing is legally a fact, immune from US court orders or sanctions. They're pricing maturity walls, not yield curves, but the hard calendar of $1.20 trillion in debt coming due, quarter after quarter. They're pricing exit velocity, how fast key foreign holders are stepping back from the dollar's settlement backbone. They're pricing fungibility, whether your gold can be swapped for dollars without asking permission. So when you see gold rise without headlines, without macro catalysts, without volume spikes, that's not silence. That's infrastructure relocating, bar by bar, vault by vault, jurisdiction by jurisdiction. No headlines, no volume. Just sovereignty, moving quietly, deliberately, and right on schedule. So if gold isn't broken, and it isn't irrational, and it isn't, then what's left? Not ignorance, not error, a different kind of time. Retail time runs on quarterly earnings, Fed meetings, CPI prints, all measured in days, weeks, months. Sovereign time runs on Treasury maturity calendars, custody transfer windows, and geopolitical thresholds measured in years, decades, survival horizons. That gap isn't knowledge, it's ontology. It's not what you know, it's asterisk what kind of thing gold has become. Retail asks, what will gold do? Central banks ask, what must gold be for us to survive the next decade? And that question changes everything. Because when gold rallies on low volume, no headlines, no ETF inflows, no macro catalyst, retail sees no reason. That's not confusion, that's the signal. The catalyst isn't missing, it's invisible to your tools. It's Poland completing its NY repatriation before the SWIFT drill. It's China settling oil trades in RMB after moving 92 tons to Shanghai. It's Japan skipping a treasury auction not once, but twice, and Saudi's bid withdrawals spiking 300%. These aren't market events, they're infrastructure milestones. And gold moves when they converge quietly, deliberately, off-screen. So don't try to time gold. Learn to time regime recognition asterisk. The moment the system's foundational layer, not its price layer, begins to shift. Watch for the silence. When gold climbs while ETFs bleed. When it rises as real yields surge, not fall. When it ignores inflation prints entirely. That's not noise. That's sovereignty relocating. Your screens aren't broken. They're just tuned to market time while the pricing layer has already switched to sovereign time. The metric isn't one number. It's the asterisk convergence asterisk. Maturity stress plus custody control plus exit velocity visible as conviction without volume. And when you see it, you won't need to predict gold's next move. You'll already know the foundation has shifted. Gold is ignoring your signals not because it's deaf, but because it's listening to something deeper. Something your Bloomberg terminal doesn't display. Something that's already begun.